Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and of course one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. Today's video, FastGraph Friday Analyze Out Loud video, is going to be on the very important foundational principle of value investing, the margin of safety. And what I've got here on the screen, Wikipedia defines margin of safety as a principle of investing where an investor only purchases securities when their market price is significantly below their intrinsic value. And that's really a key because, as I pointed out, Warren Buffett's famous rules are rule number one, don't lose money. Rule number two is remember rule number one. So, the idea here is that investing is not always about generating the highest possible total return in the future. I think that's an important objective, and I think every portfolio could have some of that into a well-diversified portfolio. But the bottom line is there are other reasons to invest. For example, people buy bonds for safety and income. And when you're a value investor investing in extremely high-quality stocks, being a value investor can be because you're targeting income and you're also targeting safety. You're not trying to make as much money you might investing in, for example, a fancy tech stock, but you do feel like you have an investment that you have more certainty about and you have perhaps a better level of income. And if you're retired especially, you can utilize that income, to support your lifestyle and do it with a lot of predictability that you don't get necessarily with high growth or hot investments. Now, I'm going to be covering 9 life and health insurers. All of them are A- rated or better. They're all extremely high quality companies. As I go through this video, my primary focus is going to just be on the margin of safety that I believe they offer. From a standpoint of the Dividend Kings, 3 of the 9 stocks are on our top buy list. Aflac is a hold, Prudential is a potential good buy, and Principal Financial would be considered a potential reasonable buy. So the 9 companies that I'm going to be covering here in life and health insurer are all A- rated or better. Okay, they start with Aflac, Globe Life, Great Western Lifeco, MetLife, Manulife, Principal, Power Corp of Canada, because one Canadian in here, and of course Prudential, and then Sun Life Financial. And what I want to do here is I want to go through each of these companies and I want to make a couple of points. For those of you who are familiar with FastGraphs, the orange line represents the intrinsic value based on a widely accepted formula. And normally in all these companies, that's going to be a PE ratio of 15. That's what companies that grow at these rates would normally be valued at. And what I want you to notice, and I want you to notice this with each of the companies I go through here, prior to the Great Recession, which occurred here in 2008, you can see that Aflac, for example, traded at very high multiples, typically above 15 times earnings, which I call a midpoint threshold evaluation. It wasn't uncommon to see this stock trading at 20, 21 times earnings, even as high as 22 times earnings. And the point is then the financial debacle that actually led to the Great Recession, where we had excessive lending, etc., really caused a reset in the valuation of finance. Now, the blue line on this graph is the normal PE ratio. And the first thing you should notice is that line is drawn at a lower level than the 15. It's actually a normal PE of 13.29 because that includes some of these high PEs with some of these low PEs. You see actually a 5 PE here. You see single digit PE ratios in the case of Aflac. So here's the point. If I shorten this time frame to where we just start coming out of the Great Recession, I want you to notice that we end up now with a valuation reference line of the normal PE being drawn at about 10 times earnings. Now, I would call this a modern day or recent historical valuation, intrinsic value reference for Aflac. In other words, around 10 times earnings. So even at 10 times earnings with a current blended PE of 9.49, I do have a modest margin of safety built in here if I was calculating it just out to the end of this fiscal year here or this calendar year. I'm trading it at about 9 or 10% below its intrinsic value. However, if I was looking at it from the standpoint of based on a normal 15 PE ratio intrinsic value, I have a very, very wide margin of safety of almost 65%. And that's very, very important. So in other words, this stock has traded at a very undervalued PE ratio of about 10 since we came out of the Great Recession. So I'm going to shorten this again a little bit. And what I want you to see here is kind of a valuation reset. We've got earnings growth of about 6% here. we have a current dividend yield of 2.8%. The stock is trading below the blue line and then again significantly below the orange line. But if I look at performance over this time frame, you'll see that Aflac has generated about the equivalent dividend income of the S&P, but it underperformed it dramatically, and a lot of it had to do with the fact that it was trading at such a discounted fair value. But if I would value this at its actual true intrinsic value, and I'm just going to do a rough calculation here for you, then it would be much more comparable to the market if it was trading at a normal 15 PE ratio. But the point is, that's why we have Aflac rated as a hold on the Dividend Kings. It's slightly below the intrinsic value based on this reset normal low multiple of 10. It's significantly below its long-term or longer-term, or what I would call more reasonable 15 PE ratio. Because if you look at it from an earnings yield perspective, this stock is trading at 10.5% earnings yield. In other words, that's a very, very high earnings yield for a quality company. So let's go ahead and go on and let's go through the rest of these examples very quickly. Now, we got Globe Life here, looking at it again for the last 12 or 13 years. In this case, we have a stock that's trading above its 12.7 normal multiple that the markets apply, but keep in mind there was a very low multiple below. If I lengthen the time frame again, I want you to notice that there were times when the stock traded at a higher multiple. It traded at around 12 and a quarter. So this has been a perennially discounted stock. It's a little above that now. It's below the 15, but it has traded at 15. But the point is, what's interesting about this stock, if I look at long-term performance here, you can see that it generated about the same income of the S&P, but actually outperformed it dramatically on a capital appreciation. And this is part of the theme that I'm going through here, is to make sure that you're studying these companies and you understand what you're investing for when you're investing in them. So this one I would consider, it's got an earnings yield of 7%, which is kind of minimal. It would be a little pricey. I don't see a whole lot of margin of safety here, but it is a high quality company with only 16% debt to capital. So it's one that, could be considered. The next candidate here is Great West Life Co. And as you can see, it's trading at a discount to its normal PE of around 12, which it's traded at since coming out of the recession. It's trading at a relatively significant discount again. If I would measure it at a 15 PE ratio, it's about a 50% discount. Now, what does this mean? This means that you can buy this stock with a 5.7% dividend yield and buy it at a very safe multiple or very safe valuation where you don't face a great deal of risk of losing all your money. And if I look at it from the standpoint of just since 2011, you end up getting a lot more dividend income than the S&P, but your capital appreciation would have underperformed the market. And so the point is, you invest in this for the current yield, analogous to how you would be investing in, let's say, a bond. Moving on, if I'm going to go to MetLife, one of the more famous, Snoopy dog companies here. It's trading at around 9 times earnings. It's been discounted at that value. It's a little bit cyclical, offers a 3.5% dividend yield. It's A- rated with only 20% debt, but is trading again at a significant discount to its theoretical 15 PE ratio intrinsic value that a stock of this type of quality would typically trade at. If I look at it from a long-term historical perspective, you can see that the marketplace has been valuing this stock at somewhere around 10 times earnings historically. So, does this have a margin of safety? There was a time when it traded at 15 times earnings, but because of the cyclical nature in this particular example, as I'm analyzing this, I would say a 10 multiple is, fair. 9.8 is what it's calculating at. So I would argue that, I've got a modest margin of safety with MetLife if I'm looking at it right now from an investment perspective. Manulife, another one that's relatively well known. If you look at this, you see a lot more cyclicality, but you do see a period where there was tremendous growth and a very high, or trading at a normal 15 PE. And then the recession, this particular company participated more than some of these others I've shown as a life and health insurer. And it obviously was hurt very badly, even caused their dividend to decrease. But then since coming out of the Great Recession, I look at it more, recently, and I'm just going to go to 10 years here. It's been trading at around 11 times earnings. It's at a discount to that. It is forecast to grow at about 5% going forward and, almost 18% over the long term. So this would be one that could potentially generate good capital gain, is trading at a very good margin of safety relative to its normal discounted multiple that the market's applied, and certainly significantly below its theoretical 15 multiple intrinsic value if the stock were again to trade at that. So there's opportunity here, but there's also a great deal of safety involved in investing in a stock like this. Principal Financial Group, this is one that is trading at around 11 multiple right now, 10.9. That's consistent, so it doesn't have a great deal of margin of safety over its normal, valuation since the Great Recession. But if I go back historically, this stock used to trade at much higher levels. It's an A- rated company with only 21% debt. Right now, you can buy it, below its long-term normal multiple, but relative to its 5-year multiple, 5-year historical normal multiple of about 10.8, it's trading right in line with that. But again, it's a good solid stock with a 4% dividend yield. And if I look at long-term performance here, we see significantly outperforming the market in dividend yield, but we see it underperforming the market in capital appreciation. In other words, this is a dividend investment or an income investment, not a long-term total return, or not a high total return investment. The next one I'm going to go to is the Canadian stock, Power Corporation, yielding about 5.8%, trading at around 11 times earnings. Historically, if I look back at this company over the longer run, it's another example of a stock that did trade at a high multiple. If I look at long-term performance, it dramatically produced more income than the S&P, but again, underperformed it on its standpoint of capital appreciation, but came in pretty good from a standpoint of total return. But the key here was generated a lot more income, and you can buy this with just under a 6% yield today. So part of your margin of safety, in addition to trading at a discount to its margin of safety, you've also got the yield advantage here. Prudential is one that I'm long in, as well as I'm long in Aflac and Principal Financial Group, primarily for the income. I've got a 5% dividend yield. I've got it trading at a discount to its intrinsic value. If I look at it from a standpoint of where it would, should be if it traded at 15 times earnings, it would be very attractive. If it trades at only 9 times earnings, which is the 5-year normal PE ratio that it's trading at, I still have a double-digit return potential here. And again, the key is I've got a stock that's generated substantially more income than the market, than the S&P, and has been comparable in terms of capital appreciation adjusted for valuation, remembering that the market is significantly overvalued today. So I do believe I've got a great margin of safety here. I do believe I've got a good yielding stock here. It's certainly got good quality at A-rated with only 21% debt. So Prudential's one that I like, and I do think the company has long-term total return appeal as well. And then finally, Sun Life. And Sun Life's another one of these life and health insurers that kind of went through a lot during the Great Recession. The company used to trade at a 15-ish PE. That's the orange line on this graph. More recently, coming out of the Great Recession, it's been trading at about a 12 PE. I've hit that wrong. Let me shorten that one more. It's been trading at about 11.8 PE. It's just below that right now. Offers a 3.66% dividend yield, and it does offer perhaps a little more growth. It's A+ rated with only 15% debt. So if I was looking at this from a standpoint of what my returns could be, if I went to intrinsic value, I could generate very substantial annualized rates of return over the next couple of years. If I just stuck with the normal multiple here, I'm using an 11.5, which has been the 5-year normal multiple, I would have double-digit rates of return. But the point is, this is a whole industry sector where if you look at it from a perspective of its whole industry, you see that it's trading at a discount to the 15 PE ratio. All of these companies have earnings yield above my 6.5 to 7% threshold, and they all have dividend yields, with the exception of Globe Life, that are above the market, and some of them are giving us almost 6% dividend yields here. So it's a whole sector that's essentially undervalued right now, and part of the story here is it's not only a market of stocks, it's also a market of sector. I hope you got some value out of this video. I appreciate you watching it. Look forward to talking to you again next week. Thanks for watching.